Hey, what's up guys? Hope you're having a great day and welcome to Financial Dragon. In this video, I will tell you guys what I wish I knew when I started investing almost 5 years ago. There's so much information out there when you Google how to make money in the stock market, and I wanted to make a video that could teach anyone how to start investing from scratch. You might have heard terms such as day trading, options trading, penny stocks, forex trading, or investing in mutual funds. I want you to forget all about those terms. Making money with trading is possible, but incredibly difficult and requires hours upon hours of learning and experience. Just think about it. If it was that easy to just sit behind your computer and through a couple of clicks make thousands of dollars every day, wouldn't everyone do it? Why would anyone ever want to go to a job anymore? The reality is that when you join the onslaught that is day trading, or any kind of shorter term trading, you start competing with the best of the best. Every time you sell your stock, somebody else is buying it. It is very difficult to compete with the likes of Goldman Sachs, JP Morgan, or other gigantic hedge funds with billions of dollars in them. I for one can't, and if anyone tells you that they can, you should not believe them. The same goes for mutual funds or any other kind of funds with a larger fee. The process of finding good stocks is really quite straightforward, and anyone who claims that it can double, triple or quadruple your returns is just trying to scam you by taking out an unnecessarily large fee. Studies have even shown that just randomly picking out different stocks out of the big indexes is about as good as listening to the top analysts, but obviously without any fee. So the takeaway here, in my opinion of course, is to learn this quite straightforward way to find good performing stocks and buy them and hold them for the long term. Where most people go wrong here, including me in the past, is they follow the news very closely and panic sell when everyone else is selling and buy when everyone else is buying. Doing this will more often than not lead to you selling the stock when it is too late, meaning when the stock has already reached a bottom, and buying when it's too late, meaning when the stock has already reached its peak or the top. And I am definitely not an exception to this rule. In fact, it's a very human thing to do. So in conclusion, if you find a stock that you think is good, simply buying and holding that stock for the long term, no matter what, is probably your best bet. Now that the main ground is covered, it is time to talk about how you can find those high quality, nicely valued stocks to buy and hold for the long term. And this is when two important terms come in: quantitative analysis and qualitative analysis. The very basic purpose of investing is to buy an asset at one point in time and wait for that asset to go up in value. In the case of stocks, this happens through capital appreciation, meaning the stock goes up in value and the company goes up in value. Or in something called dividend, meaning the company pays you out a percentage of their profit simply for owning the company. A quantitative analysis is when you look at the stock price and use hard data such as the company's revenue, its revenue growth, its book value and its profit margins, to name a few, to decide for yourself if a company is in fact worth more or less than its current stock price. Remember, the current price of the stock is just what the market estimates the company to be worth at. If you do your own analysis and come to the conclusion that it should be worth more than that, then buying stocks in that company might be a good idea. To give you a concrete example, we will be looking at two very different companies. The first one being the beverage company Coca-Cola, and the second one being Uber, which provides vehicles for hire, food delivery and package delivery, just to name a few. For simplicity reasons, we will be using one of the most famous and well-known quantitative metrics, which also happens to be a quite fitting metric to find nice companies to buy, the so-called PE ratio. To calculate the PE ratio, we simply divide its current market price with its estimated earnings for this year. As a very general rule, the lower the PE ratio of a stock is, the better it would be to buy. And I would personally love to buy stocks with a PE ratio below 20 that still have very strong fundamentals. That's a very rare thing to find. Now let's use the PE ratio to analyze the company Coca-Cola, which really needs no introduction. The forward earnings of Coca-Cola is estimated to be $1.8 per share, with a total outstanding shares of 4.3, which means that the company would make around $7.74 billion in 2020. At the same time, the entire company is worth $204.66 billion as of now. By dividing these numbers, we get a forward PE ratio of 26.44. I would say that's fairly valued, if not slightly overvalued, but I would still definitely buy it for the long term. Now let's check out Uber. A quick look at their forward estimates tells us that they expect to operate on a loss of $1.3 billion for 2020, meaning they will actually lose $1.3 billion this year. Yet, the company has a valuation of $52 billion, which means that they actually have a negative PE ratio, which according to our quantitative analyses says that that would be a grossly overvalued stock. If we instead do a simple qualitative analysis, it really makes sense why Uber is so expensive. In a qualitative analysis, you instead look at the non-quantifiable aspects of the company, meaning its future potential it has, its management, and the industry it operates in. And now let's take a look at Coca-Cola from the same aspect. Coca-Cola is dominating in its industry with over 40% of the soft drink market shares in the United States. It is still growing, but at a very small rate, simply because it's a very big company already, and it really isn't expected of it to do something new, huge and revolutionary. Uber, on the other hand, is growing at an extremely fast rate, and despite not being able to turn a profit just yet, it is still expected of it to completely revolutionize the way we look at transportation and food delivery. It is therefore expected of it to keep growing at a rapid rate and make more and more money while cutting its costs, which will in turn lead to huge profits. This is the reason why Uber looks so grossly overvalued when you just look at the PE ratio. People are expecting it to start making big amounts of money and revolutionize its industry. Now you might be thinking, okay, all of this is fine, but how can I use this information to start making money on the stock market myself? Well, a very simple rule I like to follow is to buy stocks that are more similar to Coca-Cola rather than Uber, meaning buying stocks in companies that are already making huge profits, that are already dominating their industry, and that very likely won't go anywhere due to the nature of the industries they operate in. An example of American companies that fit these criteria very well and that probably will not go anywhere are the likes of Colgate, Clorox, Coca-Cola, Costco, and Procter & Gamble. It is a pretty safe bet to say that people will always need toothpaste, toilet paper, and to buy groceries and occasionally enjoy their soft drink. Therefore, I would consider these some very safe, high-quality stocks to buy. The process of determining whether these stocks are currently fairly valued would require going through a bunch of different indicators. But in my opinion, just looking at the PE ratio would also go a very long way. I will absolutely build on this topic more in the future and discuss things such as dividend-paying companies and even discuss individual stocks. But now for the main key takeaways of what kind of stocks I like to buy. I believe that the best way for an average person to invest is to find high-quality, large-cap, fairly valued companies that have been around for a long time and that will keep being around for a very long time. The process of finding these is as tedious and complicated as you want to make it. But personally, just looking at the PE ratio, looking at the dividend history of the company, and doing a simple qualitative analysis of what the future holds for the company and the industry it operates on would go a pretty long way. That's it for today's video, guys. I would love it if you liked this video. That would help me out a ton. Also, if you have any questions whatsoever, criticisms or video suggestions, just let me know in the comments down below. If you liked this video, please consider subscribing to learn more about investing and topics similar to this one. Peace out.